We are going to discuss the everyday use economics terms in this video. The first one is GDP. What exactly is GDP? GDP stands for gross domestic product. GDP is the total value of everything a country produces in 1 year. Think of a country like a big shop. Inside the shop, people are making cars, clothes, food, providing services, building houses, etc. If you add the value of everything that is made and sold in that shop in one whole year, that total number is called GDP. Imagine a small village with 5 workers. Adam grows wheat worth 100,000 rupees. Sarah stitches dresses worth 100,000. John runs a shop and earns 150,000. David teaches students and earns 120,000. Emily builds a house worth 200,000. If we add it all together, this 670,000 is the village's GDP for that year. In the same way, when a country adds the value of everything it produces, that is the country's GDP. GDP acts like the report card of a country's economy. If GDP goes up, the country is doing well. More jobs, more business, more income, better lifestyle. If GDP goes down, the economy is struggling, jobs decrease, people spend less, businesses slow down, country faces problems. So whenever you hear news saying GDP increased by 4%, it means the economy grew by 4%. Countries usually use the production method, income method, and expenditure method to calculate GDP. GDP per capita means GDP per person. It shows how rich the average person is. For example, if a country has a GDP of 100 billion and 10 million people, GDP per capita equals 10,000. What is inflation? Inflation means the price of things keeps increasing and the value of your money keeps decreasing. Things are getting more expensive over time, and because of that, your money buys less than before. Last year, bread was 50 rupees. Today, the same bread is 60 rupees. That price increase is called inflation. Let me tell you a simple story. There's a small town called Greenfield. In this town, bread equals 10 rupees, milk equals 5 rupees, rice equals 50 rupees. Life is affordable. One day, the town chief gives everyone extra money to make people happy. Now people have more money, but shops have the same amount of bread, milk, and rice. Suddenly, too many people want bread. Bread is limited, so shopkeepers increase the price. Bread goes from 10 rupees to 20 rupees. This is inflation. More money, same goods, prices rise. After some months, the cost of making bread increases. Flour becomes expensive. Transport becomes expensive. Now the baker increases the price again. Bread goes from 20 rupees to 25 rupees. This is also inflation. When costs rise, prices rise. Slowly, everything becomes expensive and people start complaining, like, my salary is the same, but prices keep increasing. That's exactly how inflation feels in real life. There are 3 simple reasons for inflation. People want more things than the shops can supply. The cost of making things goes up. The government prints too much money. Governments and central banks use the following methods to control inflation: increasing interest rates, reducing money printing, increasing production, and controlling import prices. What are interest rates? Interest rate means the cost of borrowing money. It is the extra money you pay when you take a loan and the extra money you earn when you save. In simple words, the interest rate is the percentage that tells you how much extra you pay or earn on money. If you borrow $100 from a bank and the interest rate is 10%, you pay $110 back. If you save $100 in a bank at 10% interest, you earn $10. The interest rate is defined by the central bank of the country. In the U.S., Federal Reserve decides the interest rate. When interest rates go up, borrowing money becomes expensive. People spend less, businesses borrow less, and inflation slows down. When interest rates go down, borrowing money becomes cheap. People spend more, businesses borrow more, economy grows. There is generally an inverse opposite relationship between interest rates and the stock market. When interest rates go up, the stock market often goes down. When interest rates go down, the stock market often goes up. What is fiscal deficit? A fiscal deficit happens when a government spends more money than it earns in a year. For example, government earns $100 from taxes. The government spends $150 on roads, schools, hospitals, and salaries. The extra $50 is called a fiscal deficit. Let's understand this concept with the help of a small town. The town collects $100 from everyone as taxes. The town spends $150 to build roads, schools, and hospitals. The town doesn't have enough money to pay for everything. He borrows $50 from the bank to cover the gap. That $50 is the fiscal deficit. Big spending projects, low revenue collection, and economic support like Ike floods or pandemics, etc., are the major causes of fiscal deficit. The government issues bonds and gets loans from the IMF and the World Bank to cover the fiscal deficit. What is monetary policy? Monetary policy is the plan made by a country's central bank, like the U.S. Federal Reserve, to control money and credit in the economy. In simple words, central bank decides how much money should circulate, how expensive or cheap borrowing should be. Objectives of monetary policy: control inflation, promote economic growth, reduce unemployment, price stability, exchange rate stability, and financial system stability. Tools of monetary policy: interest rate, open market operations, means the central bank buys or sells government securities, and cash reserve requirement, etc. What is an exchange rate? The exchange rate is the price of one country's currency in terms of another country's currency. It tells us how much foreign money we get for our own money. For example, to buy $1, you need 280 Pakistani rupees. We need the exchange rate for import and export, travel abroad, foreign investment, international business, and sending money in the form of remittances. How the exchange rate works: you go to a money exchanger, you give PKR, and you receive USD. The rate at which this happens is the exchange rate. The exchange rate is decided by the demand and supply of a currency. If many people want dollars, dollar becomes expensive. If fewer people want dollars, the dollar becomes cheaper. What is the current account deficit? The current account is a part of a country's balance of payments. It records money coming into the country and money going out due to trade in goods, trade in services, income transfers. A current account deficit happens when a country spends more foreign money than it earns. Let's make it easier. Imagine your monthly expenses is $1,200 and your monthly income is $1,000. You're short of $200. That shortfall is like a current account deficit. What are foreign exchange reserves? Foreign reserves are foreign currencies and assets that a country's central bank keeps. These reserves are used to pay for imports, repay foreign loans, control the exchange rate, handle economic emergencies. Foreign reserves include foreign currencies, USD, Euro, and Pound, physical gold, SDRs, and foreign bonds and securities. What is balance of payments? Balance of payments is a record of all economic transactions between a country and the rest of the world during a specific period, usually 1 year. It shows how much money comes into the country and how much money goes out. BOP helps a country to know if it is earning or losing foreign money and manage foreign reserves, control exchange rate, plan trade and economic policies, and decide about loans and IMF programs. What are remittances? Remittances are money sent by people working abroad to their home country. Workers earn income overseas. They send part of it to their families back home. That money is called remittances. For example, John works in the U.S. His family lives in India. Every month, he sends 100,000 rupees to their home country. This monthly transfer is a remittance. What is public debt? Public debt is the total money borrowed by the government to meet its expenses when its income is not enough. In simple terms, public debt equals government loans. Governments borrow when tax revenue is low, expenses are high, and development projects are needed. Internal debt refers to borrowing within a country, such as government bonds, treasury bills, or loans from local banks. External debt means borrowing from outside the country, such as the IMF, World Bank, etc. What is the budget deficit versus trade deficit? A budget deficit happens when a government spends more money than it earns in 1 year. For example, government income is $50 trillion, but government spending is $60 trillion. The difference is $10 trillion. This difference is called the budget deficit. A trade deficit happens when a country imports more goods than it exports. For example, country's export is $25 billion, but the country's import is $40 billion. The gap between the import and exports is $15 billion. This gap is called the trade deficit. What are inflation, deflation, and stagflation? Inflation means the general increase in prices over time. Your money buys less than before. For example, bread price in 2024 is $300, but the same bread in 2026 costs $450. The $150 jump over the passage of time is due to inflation. Deflation means the general decrease in prices. Money buys more than before. For example, this year the price of a mobile is $500, but next year the same mobile phone price is $400. Stagflation equals inflation plus stagnation, no growth, plus unemployment. Prices go up, but the economy does not grow. For example, prices of food, fuel, and rent increase. Jobs are not available, salaries remain the same. What are economic growth and development? Economic growth means an increase in a country's income and output. It means the economy is producing more goods and services than before. For example, last year the bakery produced 1,000 cakes. This year it produced 1,200 cakes, means production increased and income increased. Now think at the country level. The USA GDP was $300 billion. Next year, it will become $315 billion. Economic development means improvement in people's quality of life. It means people live better, healthier, and more educated lives. Economic development is about people's well-being, not just money. It means workers now get higher salaries, they have health insurance, their children go to better schools, working hours are safer. This is economic development.